with all the fears of an economic slowdown like we were talking about, there are a lot of banks saying that they're tightening their underwriting standards, they're reining back risk, Goldman Sachs being one of them, for example. How do you feel when you're looking at the lending market right now?
Well, Sonali, great being with you as always, and thank you, and Caroline and Taylor, thank you for having me here today. So I guess a couple observations. I'd start with this. We are seeing in our private credit world the best risk-return opportunities we've seen since the inception of our business. And given the evolution of the direct lending market, that's largely reflects kind of in the history of the direct lending business in the form we know it today. So that's very much the positive news. But remember, we're also in the very long-term business. We're making decisions to make a loan to a world-class company with a world-class sponsor with the expectation, in fact, we indeed will hold that loan for the next 5 or 7 years.
So does that mean you're stepping in a little bit more as the banks are stepping back? There is a chance here to take on some risk for any given reason?
Yes, and the banks, because the banks are making a fundamentally different decision, right? At the end of the day, they're not really trying to decide, is this company, is Anaplan, is that going to be a great credit for the next 5 years? What they have to figure out is, can I predictably sell that loan to somebody else in the next few months? And that's a fundamentally different decision with a fundamentally different risk reward. If you get the timing wrong by 3 months, you lose money. Whether you got the decision right over 3, 4, or 5 years doesn't come into play for them.
I want to talk a little bit about the private lending environment, because on this program, we've had a lot of conversations about the lack of widening in credit spreads. Typically, instead of 500 basis points, it might be closer to 800, 1,000 in extreme stress environments. The answer to that has always been, well, a lot of that risk has been transferred to the private lending market. Do you agree?
I think the private lending market is providing a more steady source of capital to the credit markets, to the capital markets, which is really good news. So yes, those blowouts that you're talking about reflect a total absence of anybody being willing to step in and take a long view, because again, those liquid markets are focused on, well, how's it going to trade tomorrow? How's my bond price going to mark next week? We're thinking about, is this a great company 3 years from now that we want to get behind supporting? So the private credit markets did the same thing in the pandemic. When those liquid markets shut down, we actually become a dampening effect on that blowout. So we provide continuity for the markets and continuity for the economy that I think is actually demonstrating itself to be very healthy.
Talk to us about the continuity when you think about not only the private lending world, but the real estate business that you have too. How does the math work when you're looking at yields at 5, maybe 5.25% that we heard from the Fed? Does the math still work in trying to make money?
Well, thankfully, this is the moment our business is built for. The purpose-built is the term that's coming to mind. The products we have at Blue Owl are really built around inflation protection by virtue of having floating rate yields in the case of our lending business. In the case of real estate, triple net leases, that means that the expenses, those rising expenses, are borne by the tenant, not by the owner of the property. So really our whole product suite has been built around principal preservation, income generation, and inflation protection. So actually in this environment we do better. We just announced today or yesterday on ORCC, our BDC, that we raised the dividend on our products, on our funds. We're largely raising the distributions to people. How many people are calling their investors and saying, just want to let you know the returns are better than you were expecting?
So you mentioned the banks a little earlier also. I'm wondering, what kind of chances do you see to buy, loans off their books right now, given how much they're hung with in the middle of what was an earlier buyout boom that has really not worked out on the financing side for a long time? Can you buy at scale?
There's certainly scale, but it doesn't really suit our model. Back to sort of what we do deep, deep diligence, weeks, months of work. We do very, very tightly negotiated credit agreements, and then we're there to build a long-term partnership. And that's a different decision from that underwriting exercise by the banks. As a result, the kind of product that they tend to underwrite doesn't tend to match well with what we're looking to do. We originate. We've originated $60 billion in loans since our inception. We go out and we create those opportunities and do all the work ourselves. So really our worlds don't much intersect. And so it's an opportunity for those who trade markets. We're long-term investors. We'd rather go originate that brand new credit and make a loan to Ping Identity or make a loan to Avalara. That's really where our focus is.
Do your worlds intersect when it comes to talent? Is this now the opportunity to be taking the top bankers out of that world and coming in to originate loans with you?
Yeah, there's some wonderfully talented people at these banks, and they'll continue to have wonderfully talented people. We do have many people from that background in our organization. A lot of people that come from the investment banks and from that bank market. Yeah, we're growing. Our firm's been growing quite rapidly, and in this case, I say that very fortunately, because we've got great talent to meet the moment. But yeah, we're over 500 people now.
I'm really curious about, what the discussion looks like, too, inside, your conversation with somebody who might be leaving a bank right now because bonus season is around the corner and things are not looking good at a lot of these underwriting desks. And frankly, a lot of these banks are downsizing right now. So how does that look? Are people coming to you now?
We're certainly lucky that we're getting a lot of people who see the opportunity, taking a long view. Our investing and our firm are built around the long view. How do we make a better, distinctive alternative asset manager? And I mean that culturally. How do we make it a place that's really special for people to work at, but also, very importantly, something that has different financial attributes? As you know, our business is built on permanent capital, fee-based revenues, and therefore stability, predictability, and growth. And that is appealing to people coming from the more cyclical banking world.
Does that growth opportunity expand to suburbs and Florida as well when you think about expansion?
Well, today we have 10 offices, and we do want to be where our investors are and where the companies are. So, yes, we want to be there in the market so we can do those originations, so we can be side by side with the alternative managers that we invest in through our GP Solutions business, those buildings we're financing through our triple net lease business. Yeah, we want to be in market, and yes, we're continuing to reach out.
Marc, we reported that Dyal is about to be closing a record fund of $13 billion. Taking stakes in asset managers has been a really key business here, and you're the biggest. And so what types of asset managers are you looking at that you want to be a part of now that kind of exemplify what you think is going to be the asset manager of the future?
I think the great success of our GP Solutions business comes down to a focus on the market-leading GPs, the people who have true scale, true distinctive capabilities. And so I think what investors see is when I look out over the next 5 years and alternatives continue to be part of a growing part of dealing with volatile markets like this, the winners are going to be the CVCs and the Veritases and the Vistas, and those are the people that we focus on and really lead the market in. That fund that we're lucky enough to assemble for GP Solutions, it's twice the size of the next largest participant. In fact, adding the other next two participants together, you don't quite get to the size of our product. I only say that in so much as we have the home to be able to provide large capital sums. Again, in an unstable market, we're there to still provide capital to these firms so they can grow and build.